Good morning, Bolaho. Thank you for joining us on the program this morning.
Good morning, Chimizi. It's good to be here once again.
So, October could be described as a good month for the equities market, and on Monday it quickly reversed. Yes, we saw a drop, on the first trading day, that was Monday. And then yesterday, it quickly reversed into the green after that Monday drop. Now, fourth quarter of the year must be a great one for the equities market. Am I right?
Yes. So like you rightly mentioned before the break, we saw the oil share index crossing the 40,000 psychological mark in the fourth quarter of this year, last month. And if you look at the performance of the market last month, you saw the market posting a gain of about 5.3%, which you raised the year-to-date loss, at the start of the fourth quarter. So currently now the market is a positive region with a year-to-date returns of about, 4%. So for us, we think this is reflective of investors' expectations of, impressive dividends that will be declared by companies in 2022 in the first quarter to be specific, and that has more or less driven buying interest in dividend paying stocks. And if you look at the Q3 earnings published last week, broadly impressive performances across board from the banking sector to telecoms and oil and gas sector as well. So this is more or less supported investors buying interest in the market. But yesterday we saw more of profit-taking activities as investors decided to book gains on those stocks that have recorded significant rally over the last 7 weeks.
Now, the Nigerian stock market was set to be the best performing market in 2020. That was despite the pandemic. With the trend that we are beginning to see this fourth quarter, do you see that happening again this year?
Yes, last year was a different year entirely, and we don't think some of those events that supported the markets last year, and unfortunately, are likely to play out this year. If you look at, yields in the market, in the fixed income markets last year, at all-time low levels. Below the entire yield curve was below about, 6%. And if you look at yields on treasury bills, about 1% levels. But this year, we've seen significant advancement in use in the fixed income market. So that singular factor alone implies that the gains we see in the market this year is unlikely to match the gains we saw last year. But what is more important is, with the positive earnings we've seen thus far from companies, we think it will remain supportive of a broadly positive performance in the fourth quarter of this year. For our based on our estimates, we expect the year-to-date returns in 2021 to settle at 5.5%, and as of yesterday, we're already at 4% levels.
About the earnings that have been published so far, how would you assess the performance so far? Which results stood out for you?
Yeah, so looking at it generally, I think earnings published by companies across sectors has been broadly impressive. But if you want to probably pick out the star performance, you look at the likes of MTN. So we've seen sustained growth in data revenue. That has been supported by the country's favorable demographics, in addition to the company's investment in, improving 4G coverage across the country. We've also seen recovery in voice revenue that was significantly affected last year due to lockdown rules that affected activities in the informal sector. But we've seen sustained pickup in voice revenue. So MTN, we saw strong earnings from MTN as at the 9 months of 2021. In the oil and gas space, we also saw strong numbers from Total, which is more or less the market leader in the downstream space. So the company has been able to more or less leverage on its strong footprint, wide range of retail outlets in pushing volume. So that really supported its performance for the 9 months of 2021. For the agri players as well, Oil and Presco, we also saw very strong numbers from those players in the agri space. Given higher prices of CPU in the international market, in addition to recovery in demand in the domestic market, given the full reopening of the economy. So those were the star performance in the third quarter of this year. However, the major concern for us, has to do with the consumer goods company. And what you observe is the fact that cost of sales grew faster than revenue, which is, reflective of the impact of, higher cost of importing raw materials, given the devaluation of the currency, in addition to, high level of inflation in the economy. And of course, for consumer good companies, as a result of, the faster increases in cost of sales, that's affected, margins. We saw, margin compression across board. So that still remains, a significant pressure point for companies in the consumer goods space. But all in all, we think the Q3 earnings were broadly impressive.
What about the banking sector? What do you make of the results so far from the companies there?
Yeah, so for the banking sector, more like a divergence, which is very similar to what we saw, Q2 of 2021. So if you look at the likes of Access and UBA, they were able to deliver stronger growth in earnings. Why? Zenith Bank more or less delivered flattish growth in earnings. For GT Bank, for GTCO now, the holding company, they delivered, decline in earnings. But for us, looking at the factors that sort of influenced earnings in the banking space. In terms of yields on assets, that still remain largely pressured. Given the lower yield environment that kicked off since the 2020, that's the prior year. Aside that, we also observed that banks have continued to record significant growth in fee and commission income. So if you look at major line items like e-banking fees, ATM maintenance fees, charges rather, we've seen significant growth in those income lines. And we think this is largely supported by the reopening of the economy, which has more or less allowed consumers to begin to go back to their usual daily activities bordering around general commerce. All of these activities have picked up. Another income line that we are also impressed with in their income statement has to do with impairment charges. So last year we saw banks recording very high impairment charges due to the weak, macro conditions. But thus far this year, we've seen gradual reduction in, impairment charges, and that has continued to support, their performances. So for those that were able to perform, exceptionally well compared to their peers, Access and UBA, and that's just that was supported by their ability in growing their loan book faster, which more or less supported interest income on loans and advances. But for the likes of, GT and Zenith, they also grew their loan book, but not as much as we saw in the case of UBA and Access.
Okay, let's look at the fixed income market. What is your assessment on the level of activities there?
Yeah, so looking at the fixed performance of the fixed income markets last month, we saw yields in the treasury bills markets advancing by about 8 basis points, which is just, marginal. In the bond space as well, we saw yields advancing by about 9 basis points. And we think this was due to investors' reaction to higher stop rates offered by the DMO at the bond auction conducted in the prior month. And again, we also noticed that some investors more or less decided to liquidate, their investments just to free liquidity in order to buy the Euro bond launched by Access Bank of about $500 million. So we think those two major factors were responsible for that slight uptick in the yields in the fixed income market in the prior month. But looking ahead into the rest of the year, our expectation is that given the recent Euro bond raised by the federal government of about $4 billion, that should reduce the federal government's reliance on the domestic market in terms of issuances of domestic debt instruments. So we think that should be supportive of lower yields in the fixed income market going into the end of 2021. But more importantly, we think the GMO would also remain concerned about minimizing the cost of debt servicing to the federal government. Given the current high level of debt servicing cost, we think that would also play a role in keeping yields at these slightly low levels as we go into 2022.
Now, and to the FX market, considering the significant increase in the FX reserves, what is your outlook on the currency for the rest of the year?
Yeah, so for the foreign exchange reserves, we've seen significant accretion in the FX reserves, given, the federal government's raising of Eurobond, in addition to IMF SDR of about $3.4 billion. So currently, our reserves, currently at about $1.7 billion, which is, just shy of about $42 billion. So what we expect is, that should improve liquidity at the I&E window. And to just give insights on the state of liquidity in the I&E window, and between the months of August and October, we've seen significant improvement in, the average daily value traded at that market, at that window rather. So if you look at, as of August, average value traded stood at about $120 million. But if you look at the average in September and October combined, we are currently at around $200 million. So that is a significant improvement, and we think it will be sustained, for the rest of the year, given, the strong level of external reserves that should improve the central bank's ability to supply dollars, to that window. But we still see scope for, further adjustment in the currency. And the reason for that is most of the inflows that we've seen into the country this year that has supported the external reserves are more or less one-off inflows. And of course, those one-off inflows are likely to provide, medium to long-term solution or stabilizing the currency. So we think the CBN will still need, inflows from, FPIs. And to do that, they probably have to adjust, the currency at the I&E window from current levels of 410 to 415 to about 440 to 450 levels. Just to give, incentive for FPIs to bring, those dollar inflows, back into the country, following, the massive outflows we recorded in the prior year.
Now, you and I know that the central bank is not attuned to price adjustment at the FX market, but given the situation in the market now, do you envisage the return of FPIs into the country?
Yes, we see scope for, gradual return of FPIs back into the country, but we think, those inflows are likely to be, very significant. And the reason for that is we still have, sizable backlogs at the I&E window that, the CBN is yet to clear. So if CBN is able to do that, in the fourth quarter, then, that would sort of improve, foreign portfolio inflows back into the country. But I think looking, beyond the fourth quarter, and if you look, further into 2022, being a pre-election year and the fact that, foreign portfolio investors tend to attach, higher political risk to the country, that would, more or less constrain them from, returning back in droves, into the country, just like we saw, in 2017 when we just, came out of a similar, dollar crisis in the economy. So we think that is sort of, a factor that would put a cap on, the extent to which foreign portfolio investors would turn back into the country. But nonetheless, we think that, with improvement in liquidity at the I&E window, we should see, improved, dollar inflows into the country. But certainly, we don't think it will be as significant as, widely expected.
Now, African central bankers, of course, will be meeting this month at various points to, talk about the next monetary policy environment. What are your expectations from the Nigerian Central Bank?
Yeah, for the central bank, we don't expect any major shift from the guidance they have given to the markets earlier. So they have communicated that, their short-term policy objective is to support, economic recovery. And we think that is likely to be, re-emphasized at the last policy meeting, holding this month. So we still expect MPR to be maintained at 11.5% alongside other policy parameters. But what we think is more important is, the CBN should be able to give, forward guidance on when, they intend to switch to a more, hawkish policy just to, push down inflation, downwards, and probably also address the imbalance in the external sector. But for the month of November, we still expect the MPC to maintain status quo across, those monetary policy parameters.
All right. Thank you very much, Bolaho, for your time on the show this morning. We do appreciate it.
Thank you very much. Do have a nice day.
And you too. And FX Commodities Market Update is next after the break. Do stay with us.